coordinators through Empire Justice Center. The other two, one is Ellie Pepper, and then we have Maria down in Long Island. So I would just like to say that I'm very pleased to introduce Joseph Rubella and Erin Jacobs-Smith, both staff attorneys with the MFY Legal Services Foreclosure Prevention Project, both representing homeowners in foreclosure. They have both been working in developing this FHA Waterfall and HAMP and GSE Waterfall Worksheets, and they have graciously agreed to teach the rest of us how to effectively use this very important tool. Joe and Erin, thank you again for your time and your expertise, and I'd like to hand it off to you. Thank you.
Thank you very much for the introduction. I'm Joseph Rubella. As was just said, I'm staff attorney at MFY Legal Services. And today we're going to be walking through two Excel worksheets that we've created to help everybody deal with the variety of programs that are out there. First, I'm going to walk through the HAMP and GSE standard modification worksheet. Then I'm going to switch it over to Erin, and Erin's going to walk you all through the FHA loss mitigation worksheet. I'm going to note right now that because we're doing this webinar in under an hour and covering multiple loss mitigation programs, we're going to assume familiarity with the underlying programs and focus on the nuts and bolts of using the worksheets themselves and how it can aid you in your practice. That said, if you have a follow-up question related to the programs, if you have a more in-depth question about the calculation methods, if you have suggestions about further additions to the worksheets, or if you find a mistake or error in the worksheets, our contact information is in the program materials, and we'd be happy to address any of those issues outside of this webinar. After we go through each worksheet, we'll be taking a few questions on that worksheet. So I'm going to start off with actually the process of getting the worksheet, because the first and most important thing about the worksheet is to always have the updated version. We're constantly updating it, increasing functionality, and removing bugs or errors in the calculation. The best way to easily keep an updated copy is not to save a copy onto your hard drive, but to link to the web address of the worksheets. So I'm going to start out by showing you how to do that. The first step is to go to the MFY Legal Services website, which www.mfy.org, pretty easy to keep track of. Then go to our projects, foreclosure prevention, and you get to the Foreclosure Prevention Project website. So right here is the two links to the waterfalls and their guides. Since I'm going through the HAMP or GSE standard modification waterfalls, we'll start with that. So you right-click on the link that you want, and you copy the link address. Then you go to wherever you want to save it. So I'm just going to do it here on my desktop because that's easiest. So new, shortcut, and then you paste in the results that you just, the link address that you just copied. You name it MFY HAMP Waterfall or something to that effect. And now when you click on that, you'll actually, your browser will open, you'll go to our website, and you'll download a fresh Excel file straight from us, so that if we've made any changes since you've last downloaded it, you don't have to worry about that. You'll have the freshest, newest copy. I'm going to close this and save one that, go off one that I've preloaded up. But this is how it looks. The next thing after you download it is to save it. We recommend that you save each waterfall based on your client name. This has two effects. So first of all, I'm going to just call this client name waterfall. First of all, it allows you to enter in new data for each client without losing your old data. And second of all, when you go to print it out, the client name will display prominently. I'm going to show a print preview. So now this way, you know, if you print it out and you have a hard copy, you know what client name it is, and you have the date that you ran it, so you know if it's up to date or if you need to rerun it. If you're an attorney and you're representing a person in settlement conferences, you can take a copy of this, put it in your file, and then if you're arguing about something in the waterfall, you have a sheet that looks like it's more than just numbers on a page. Let's see. So the actual sheet itself, just going to go through the Inputs tab. There are 4 different tabs, but you should always start with the Inputs because this is where you're going to put in all the information about your client. So let's see. We'll start with the top left, the estimated value of the property. This is pretty straightforward. It doesn't need to be too exact, but it is used for calculating the levels of principal forbearance in both HAMP Tier 1, HAMP Tier 2, and both GSE standard mods. The next question is whether or not it's a rental property. If you're dealing with somebody's second home, maybe it's not something that you're personally going to represent them on, but you want to give them some sort of advice. You say yes, it changes that up a little bit. We're not really going to go through the rental properties inputs because this is really focused on saving people's primary homes, but everything on the rental properties is discussed in the materials, and if a question comes up, once again, feel free to contact us. The next big section is income. There are lists of all the different types of income that people tend to have: employment income, contribution income, their monthly fixed income. This is like a taxable income that's provided on a monthly basis, like a pension. Monthly untaxed income, this would be like food stamps or some kinds of Social Security. And as you know, income is treated differently for HAMP purposes. So untaxed income is grossed up by a factor of 25%. Income from renting your primary residence, which would go right here, is brought down. It's reduced by 25%. And income from renting out a second property, a rental property, is reduced by the 25% and then reduced by the housing cost on the second home. As for employment income, to make this a little simpler, most people that you see won't get paid monthly. They'll get paid weekly, bi-weekly, bi-monthly. Some of them are monthly, or maybe you'll have an annual or a year-to-date total. So as you can see here, this person in the example gets paid bi-weekly, and they get paid $1,250 every 2 weeks. So the worksheet adjusts their monthly income up to show the effect that they're getting paid more than once a month. Now, if they're bi-monthly, then their monthly income is just double that, goes through weekly, same principle applies. And annual, we're just dividing by 12 there. Little note on the year-to-date. This is good for if you have somebody who has irregular income, they're a profit and loss person, or they have sort of unsteady overtime. Basically, you do year-to-date, YTD, and then the date that they got paid. So if you had somebody's paycheck from, let's say, last month, and you could tell from their year-to-date that they were getting paid irregularly, you could say, well, this person's earned, in this case not that much, over a little under 4 months, and the worksheet will sort of average that out into a monthly figure. Let's change that back to biweekly. And down here, co-borrower income. If you have more than one person on the note, you can enter a little truncated version for the co-borrower. And it all totals up, and then this is the gross monthly income that's used in the majority of the HAMP calculations. Now, over on the right panel, this is information about the mortgage itself. The first input is owner type, and we have 3 owner types. There's Fannie Mae, Freddie Mac, or a non-GSE, so a securitized trust or a portfolio loan. And those all change other inputs in a way that I'll discuss briefly in a little bit. Then the loan terms, original principal, this is the amount that the homeowner borrowed. The term in months, so 360 months is 30-year mortgage. If you have a 15-year mortgage, it'd be 180 months. And if you had something that maybe previously been modified and the term had been extended to like 480, then you would enter that in there. The next is the current interest rate. Even if you have somebody with an adjustable rate mortgage, we really only want to input the current interest rate here. Next is date of first payment. Note that this is the date of first payment, not the origination date. So somebody who takes out a loan in mid-June, as I believe the example is, and in case it's not clear, this is roughly the example that's in the sample borrower walkthrough in the PDF materials that were sent out by link. But the sample borrower got their loan in mid-June, and the date of first payment is usually a full month and then the next month. So if somebody takes out a loan on, say, June 3rd, it's likely to be, a full month is July 3rd, and then you go the next month, so August 1st. And except maybe in some very rare circumstances, the date of first payment will always be a first of the month. Then we have monthly property taxes, homeowners insurance association fees. As you know, sort of the key term is the PDIA, principal, interest, taxes, insurance, and association. So those make up the rest of the PDIA. Now here, this is an amortizing fixed rate loan, meaning that this person has 30-year fixed rate at 7.5%. But as we know, not all loans are like that. So let's go through the other loan types. So if you have an amortizing arm, then you'll need to enter the monthly principal and interest payment. And an amortizing arm would be basically any sort of standard arm where the person's paying, they're fully amortizing the loan, but they're just paying an adjustable rate. It would also be like a pay option arm where the pay option has expired, and they're now amortizing the loan, as long as you put their current principal and interest payment. If you have somebody with a balloon payment, then you need to input the amount of the balloon. Another option that we have is if somebody had a previous HAMP mod, or really any previous mod with principal forbearance, meaning that the principal part of it is put off to the side and does not bear interest, then you can select that, put in the current P&I payment and the amount of principal that was forborne. I'm also going to note that for previous modifications, it'll work best if you put in, if you have a previous modification, to put in the first date of payment on the modification, the number of terms in the modified loan, and the original principal of the modification. So if somebody did have a previous HAMP modification, their date of first payment will be sometime in 2009 or later. Their term in months could be, smaller than 360 if they didn't get term extension, all the way up to 480. And their original principal is going to most likely be more than they initially borrowed because of the capitalization of arrearages. The reason why you put in these, what type of loan it is for this next part, the UPB information. So as you know, HAMP works off of your capitalized UPB, which is the amount that you owe on principal plus your eligible arrearages. Now, sometimes you have the capitalized UPB. You know, you've gotten a reinstatement figure or you've requested it from the lender and you have an exact amount. And that's great. And you can select as your UPB information, capitalized UPB, and enter that amount. The difficulty with this is that goes stale. It goes stale very fast because interest accrues on a daily rate. Property taxes are accruing. It's the frequency with which you pay them. Same with homeowners insurance. So that will not be good 2 months from now. Whereas if you do UPB at default, which is listed in all foreclosure complaints, and even if the person isn't in foreclosure, can be found pretty simply on the statement as the UPB, not as the interest arrears or other arrears. And then you enter in the default date, and the worksheet will figure out how long they've been in default using today's date, and figure out how much interest has accrued, how many tax and insurance contributions they've missed, and then you'll need to enter in legal fees and bank foreclosure fees and costs, since those are also capitalizable. Now, if sometimes you'll be meeting with the borrower at a clinic or talking to them over the phone, and they won't know that. They'll really only know when they defaulted. So then you can select only default date. You're going to be much less precise for a variety of reasons than if you do UPB at default, but based on what type of loan you have, the calculator can still come up with a fair estimate based on what would need to happen in the loan. So if it's an amortizing fixed rate, it's very straightforward. If it's an amortizing ARM, it can figure it out based on the amount of principal and interest payments. Ditto for balloon payments. Ditto for previous HAMP modifications. What it cannot do is other, which could be some bizarre financial product that we don't really need to get into. But then you'll just get sort of this warning that it cannot calculate using only the default date. So let's give the sample borrowers back their amortizing fixed rate loan and their UPB at default. Let's see. So I've already covered fees. So the next part is the market interest rate. So HAMP final interest rates are based on the Freddie Mac PMMS for 30-year fixed rate mortgages. This box right here is a link to it. Let's see if that looks up. There we go. So this will load up in a second. There we go. So for right now, the 30-year fixed rate mortgage is 3.75. So you just enter that in there. The risk adjustment is related to HAMP Tier 2. And that's right now set by Treasury guidance at 0.5. They might change it at some point. When they do, we'll update the sheet. So that's for non-GSE loans if you don't have a Fannie Mae or Freddie Mac. Now let's look. If you have a Fannie Mae, then the risk adjustment doesn't apply to you because you're not doing HAMP Tier 2. You're doing a standard modification. Instead, you need the Fannie Mae mod rate, which is, again, the link pops up right here. You can click to it. The current one is 4%. Similar concept applies for Freddie Mac. So now I'm going to walk through the results, the outputs on these other tabs for a borrower with this information. So this is the HAMP Tier 1 waterfall. This should be really familiar, so I'm not going to go through it in too much detail, but basically we capitalize the arrearages, we take 31% of gross monthly income, and figure out how much of that can go to principal and interest. And then we go through the steps. Here, reducing the interest rate would reduce the interest rate below 2% to actually a negative percentage rate, so we can't do that. So we extend the term, but we would need to extend the term for more than 480 months, so we keep going, and we forbear principal. And in this case, our forbearance is less than the maximum, so the borrower is eligible for Tier 1. Now on to Tier 2. Tier 2 is a little bit different. We, again, capitalize the arrearage, but then we're just going to set the interest rate to, in this case, the Freddie Mac PMMS plus 50 basis points. We're going to extend the term automatically to 480 months. We're going to go through a slightly different forbearance calculation, and then we're going to test for affordability. So the rule for Tier 2 on the affordability is that servicers are free to select their own DTI range, but it has to at least include 25% to 42%, can go as wide as 10% to 55%. So here, these borrowers, their post-modification PDA payment would be only 38% of their income, so they're going to pass this waterfall too. And again, the principal reduction requirement. So when we go to the mod terms, we can see sort of a detailed breakdown of what their modification terms would be under both of these waterfalls. So the new payments are built, from the Tier 1 waterfall. This is their capitalized UPB. This is the amount of principal forbearance they require. Their interest rate dropped down to 2% initially, and they have a 480-month term. Down on the Tier 1 schedule, you can see that for years 1 to 5, their interest rate will be 2%. In year 6, it'll step up 1 percentage rate to 3%, and then it'll go to the rounded 30-year PMMS, so they'll be paying 3.625% for years 7 through 40. And this schedule is useful, I think, for helping the borrower plan out sort of how their payments will change over time, so that they know that even though they're going to be paying 31%, now they might not be paying that for the entire life of the loan. Now, the Tier 2 is a little bit different since it's just a fixed rate for 40 years, so there's that information. Now I'm going to change it up a little bit, only very moderately. First of all, let's look at what happens if they have a Fannie Mae loan. So if they have a Fannie Mae loan, again, we've entered the Fannie Mae mod rate. Tier 1 will be exactly the same because Fannie Mae runs Tier 1. But the Tier 2 tab will be different. First of all, we're not going to be running Tier 2. We're going to be running a Fannie Mae standard modification. Again, the interest rate is different. And so the biggest change right here is that for Fannie Mae, they allowed debt to income between 10 and 55% entirely. So as long as somebody's in that range, they've passed this part. The other big change that's going to happen is Fannie Mae and Freddie Mac don't have an MPV test, but they do have a marked-to-market loan-to-value ratio test. So let's say that this property becomes worth much more, becomes worth $1 million more. Now, these borrowers have a very low loan-to-value ratio. So when they look at a standard mod, they'll see that their LTV is below the 80% limit, and they're not eligible for a standard modification. Now, that same person, if they had a non-GSE loan, would still potentially be eligible for a modification depending on whether their servicer had a debt-to-income range that went up to basically 45%. Let's crash the market again. And then the next thing to know about the Fannie Mae Freddie Mac situation is that as of March 27th, they've announced that they're going to be changing their rules slightly. Basically, they will be, one sec, make it Fannie Mae. Okay. They will be doing away with this 10% reduction and making it a just straight deduction test. So, is the new P&I less than the old P&I? And for some people who get those new streamlined mods, which are sort of no doc, no application modification, they'll effectively be getting rid of the new, of the DTI 10 to 55% range because they won't be testing for income. So the worksheet as is set now is programmed to test whether or not we've reached July 1st, which is the effective date of those rules. And as of July 1st, these fields will change accordingly. This is sort of another reason why it's always important to have the most updated version of the worksheet, because these programs do continue to evolve and changes do continue to be necessary. Now I'm going to show, and on the last page, it no longer shows as a Tier 2 mod, it's a standard mod.
So is this now a good time to pause and answer some questions that we have out there?
About 1 more minute.
Okay.
So I'm going to quickly go through one more sort of display thing here, which is what happens in sort of different financial situations. So let's reduce their income. And you'll see now that they're going to fail the Tier 1 because they need more forbearance than is allowed. But they're still going to pass. All right, move them back to non-GSE. And they're only sometimes going to pass Tier 2 because now their debt-to-income ratio is going to be at 52.48%, meaning that depending on what the servicer's policy is, they may or may not pass the Tier 2 waterfall. So when you go to mod terms, it will show that they're not Tier 1 eligible. It'll show how much money, how much income they need to become eligible. So right now they're at $4,800 a month. They need to get to at least 54. And Tier 2 terms are replaced by potential Tier 2 terms because they may or may not qualify. Conversely, if we increase their income to, say, $50,000 as part of their annual component, then they'll pass the Tier 1 waterfall sooner. They won't need as much term extension, and they won't need any forbearance. So those parts will just blank out. So when you see their mod terms, you'll see that they have less than 480 payments and less than 480 payments. And one last situation, if it goes as high as $80,000 right there, they will only need interest rate reduction and not even all the way to 2%, so they'll have less steps in their interest rate. Okay, and then, yeah, let's do questions on this part, and then I'll change the presenter over to Aaron, and he can walk you through FHA.
Okay, great. So we've got a couple of online, the text questions, I guess. The first one is, does the date of rate change have an impact on the modification?
Yes. So if you have, this is sort of a HAMP question, but I think it's if the rate's going to change in the next 120 days, it changes what HAMP thinks of as your principal and interest payment for purposes of checking whether your 31% whether you've met the requirement that your PITIA payment is above 31% of your income. Otherwise, if either you're solidly above 31%, or if you're not near a rate change, then it doesn't matter.
All right, and so then how is that reflected in this worksheet? Is it just based upon how you put in the data in terms of today's payment and today's default amount?
So upcoming rate changes wouldn't affect your default amount, but yes, it would change what you put in as the current interest rate.
Okay, fair enough. I hope that answers Kanisha's question. And then we have two folks that have their hands up. I'm not quite sure whether they're on by phone or whether they're on through the computer. If you're on by the computer and you have a mic, Michelle, are we able to unmute those two folks?
We can try. Give me just a moment here.
All right.
Okay. I was able to unmute Phil Barton. Can you hear us? Okay. If he's watching and listening through his computer, he may not have a mic. So.
Okay. All right. Well, then, Phil, if you're able to put your question through the chat window, we can address it from there. Or if you wanted to, you can feel free to email me. If other folks are more comfortable with that, my email address is rcase@empirejustice.org. And Ellie, I think we may have answered your question, but if not, let me know. All right, I think that's it for now.
Okay, great. So I'm going to change this over to Aaron.
Okay, hello everyone. My name is Aaron Jacob Smith, and I am going to be going over the FHA Waterfall Worksheet. So I'm expecting that some of you are not as familiar with FHA's loss mitigation programs as you all are with HAMP and Tier 1, Tier 2, perhaps the Fannie and Freddie standard modifications. But I do want to emphasize that we're really just going to be focusing on the worksheets right now. We can try and answer some substantive questions, but those would be better kind of offline, maybe email us. But really we're going to try and just get people familiar with how to use these tools. But I just as a brief background, I will say FHA is an insurance program, and basically the deal is that as servicers or as lenders, you get the benefit of that insurance if you comply with their guidelines. And so these loss mitigation programs are embodied in those guidelines. There have been some really significant updates, and this worksheet reflects those updates. And those are contained primarily in Mortgagee Letter 2012-22, and they went into effect March 15th, 2013 this year. So just be aware that these new rules are in effect right now. Also, just as a general note, I just want to say that there is no NPV test for FHA loss mitigation programs. So once you run the waterfall and figure out, say, if a borrower is eligible for a certain loss mitigation option, the servicer should provide that loss mitigation option. There's not that further NPV hurdle. So the first tab here we have labeled budget, because there's actually going to be two input tabs for FHA, for this FHA waterfall worksheet, because there's a lot more inputs. So you'll see on the left-hand column there's monthly income, and a lot of this is going to look very familiar from the stuff that you saw or from what Joe has just presented. This is a sample scenario. It's the same one that you'll find in our guide. In this case, the borrower, we have a year-to-date figure for the borrower, so that's selected as timing of employment. As Joe already explained, we have here, this is the date that payment was issued, and the calculators calculate what the monthly income is. So what I'm going to draw your attention to, though, is a few things here. If you look at the untaxed income, we've left in the grossing up function. We've also left in the reduction in, or the reducing the rental income by 25%, just like you have in HAMP. But I should note that FHA guidance it's pretty cryptic. It's not nearly as exhaustive and detailed as HAMP guidance or the guidance that's offered by the GSEs. So they don't actually specifically say that you gross up or that you reduce rental income by 25%. So if you're close, you can play with those things. We put it in there based on FHA's standards for loan origination and how they count income for different borrowers. And so they do have those rules on the origination side. And so that's why we made the judgment to put them in there. Another section that's new here is the deductions from paychecks. For FHA loss mitigation, you need to know what their net income is in addition to what the gross income is. So here, you'll need to see their paycheck if they're, say, a W-2 employee, and go through and enter in the total deductions by these categories that we've already broken down here. And you'll note that this works in tandem with the timing of employment box that you've selected above. So all of these deductions are year-to-date deductions based on that pay stub. And then this is the totaling down here factors in where we are in the year and makes it a monthly deduction amount. You have that same functionality here with the co-borrower, basically the same fields with the exception of rental income. Now this will all be new. Here is the monthly expenses. So not only does FHA care about what your net income is, but they also care about what your surplus income is, so the amount that's left over each month after you've paid all of your bills. Here again, they haven't really offered much detailed guidance as to which expenses to actually include or what's going to be required here. We kind of did some digging and found a reference to a very old form that's no longer available on HUD's website, and so we looked at that and found some expense information there and put in all those fields, and then talked to a HUD certified counselor to see what they've been submitting for FHA loans, and basically worked off of that to come up with this list of expenses. But just know there may also be some flexibility here. The guidance is just not very clear. So we kind of erred on the side of putting a lot more in. I'll just make a note here on the other loans. So for recurring debts like credit cards, student loans, for those of you who've done some FHA work before, the new FHA rules have eliminated the back-end DTI. So this is not going to be a factor in that regard. This is only going into surplus income. So now we'll go to the next tab here, and we have a few more inputs. So now we go into mortgage information, and this is going to be just like very similar to what Joe already explained, but I'm going to highlight a few differences. So one thing that affects all of this a lot is that there's MIP, there's insurance on FHA loans that borrowers have to pay as a part of their monthly payment. And so we've built in a function to calculate what the MIP is, because we found that most often people actually don't know what portion of their payment is the MIP payment. But because we're calculating that, it requires a few extra inputs. One is the original value here. MIP is based on the value of the home at the time the mortgage was originated. So that's what you'd want to put in there. It's also based on if you have an adjustable rate mortgage, the amortization schedule that MIP uses is based on the original interest rate. So that's why now when I went to ARM, we now have an original interest rate, and we have an original interest rate here, and we have a current interest rate here. To take a step backwards, just to explain that a little further, the reason we need that is because MIP is removed after the loan has dropped below 78% LTV and the borrower has paid for 5 years. So in order to figure out when you'll get to 78% LTV, you need to know that this original amortization schedule. And that's also a function that's built in. So if based on where they're at in the loan, we can see that they've paid for 5 years and they've dropped below 78% LTV, then the MIP will be zeroed out. The other thing to note here on MIP is this box here for whether or not the MIP has been financed up front. That means whether or not it's been rolled into the balance of the loan. So we suspect that most borrowers, if they're getting an FHA mortgage, did finance the MIP, so they didn't pay it at the closing just out of pocket. It probably went into the principal balance. It's important in calculating the monthly MIP to know whether or not it was upfront financed, because they're not charging interest, they're not charging the insurance premium on that financed amount. So that's sort of excluded when calculating the monthly MIP. Another thing to note here is the arrears calculations. So with FHA, unlike the other programs you're probably familiar with, arrears means something different. Arrears is just the missed payments, the total missed payments. So in this case, if your PITA is around, a little over 3,000, you've missed 2 payments, it's going to be a little over, in this case, 6,500 or so. So that's arrears for the purposes of FHA. It's important to keep that distinction in mind. So then we have many of the same fields that we see in the other worksheet. We have the default date, today's date, total months in default. A quick note on the fees and costs. FHA has issued guidance on what they think are reasonable attorney's fees and costs for a foreclosure. I've entered in $1,850. That's the amount that they allow in New York. I think they even put it down to New York metropolitan area or New York City. And that's the maximum amount that can be charged for a completed foreclosure. So, I mean, in our practice, we see some very high fees and costs, so I kind of like to highlight that little piece of guidance. We have a few different calculations for principal balances. This is going to be important once we go into the waterfall, because you use different UPBs at different stages. It's going to get a little confusing, but again, this is not a substitute for knowing the basics of these programs. I would highly suggest, if you're not familiar with this, reading Mortgage E-Letter 2012-22. But quickly, we use UPB today. That's basically as if the borrower is current, what their unpaid principal balance is. UPB at default, that you should be familiar with, and then we have a capitalized figure. We also use there's also a market interest rate here that comes into play for FHA loans. Same kind of thing like Joe was explaining. It says just rounded to the nearest 1/8 rather than rounded up to the nearest 1/8, so that's why this isn't higher. Then this other field that's going to be new here is the previous partial claims. So part of FHA loss mitigation is what's called a partial claim, and I'm going to go into that in a little more detail in the next sheet. But this is really important to enter, and because the amount of the partial claim amount that anyone can be eligible for is offset by a previous partial claim that's been awarded. Okay, and then this next column here is, these are all calculations. There's no more inputs. And this is now that we have the mortgage information, and in the previous sheet you've already entered in all the borrower information, now we can calculate these different types of income. So you'll see here we have a net income calculation, and that's just based on gross monthly income less the monthly deductions. But now that we have the mortgage information and you filled out the budget side, we also know what their monthly expenses are. And that's what's going to give us the surplus income. So that's net income less the total expenses yields a surplus income. So now let's go into the waterfall. So you may notice at the top here that we start with steps 3 and 4. We modeled the waterfall off of the sheet that they produced, that they have as an attachment in the mortgage E-Letter that announced these new rules. I'm pulling that up right now. This is what their waterfall diagram looks like. And so we were basing our translation of it off of this attachment. This is in Mortgage E-Letter 2012-22. It's available on HUD's website, and I think I do have citations to it in the guide to the worksheet, so you can, if you're having any trouble finding it. So what I've skipped over, steps 1 and 2, are if there's basically, you're looking at to see if whether or not someone can get informal forbearance is one of them. If there's no hardship, that's a forbearance where there's basically 3 months or less, generally kind of a repayment plan. So let's just, but basically, for most people we deal with, those aren't relevant. And also those first 2 steps, pulling this up again, don't really require any calculations. So you're asking here first, is there verifiable loss income? Yes, no. One or more mortgagor is currently employed. Again, these don't really require calculations, so we're just going to expect people that are doing these assessments to know these rules, and they won't proceed to the waterfall if they get caught in one of these earlier steps. So moving to steps 3 and 4, the first thing you need to ask is whether or not the surplus income is greater than $300 or 15% of net income. So if it's not, so this, in this case, for this sample borrower, it's yes. If this were to be no, you would skip straight to FHA HAMP according to the waterfall terms. But because here this borrower, the sample borrower, meets these 2 criteria, you move on to check to see whether or not 85% of surplus income is sufficient to cure the arrears in 6 months. Basically here you're looking at to see if they can get a formal forbearance plan, which is basically FHA term for a repayment plan in 6 months. In this case, it would take 40 months to pay off the arrears using 85% of this borrower's surplus income. So I don't know if there was an audio issue here. Okay. So given that this borrower in the sample here can't repay those arrears in 6 months, you need to then proceed to the next step in the waterfall, and that's checking to see if they are eligible for a loan modification. And FHA doesn't call this FHA HAMP. You haven't gotten to FHA HAMP yet. Now this is just kind of like a standard loan modification. And what you do here is, like a lot of the other standard loan modifications, and like Tier 2, you basically capitalize the UPB. You're setting this now at a market interest rate. That's all based on the previous information there that we've already entered. And now you look at, okay, what would be the monthly mortgage payment, the PITA payment, for this modified mortgage. In this case, it's $3,151. And now to check eligibility, you need to see whether or not this standard modification does 2 things, whether or not it will reduce the monthly payments by 10% and reduce those payments by $100. So both of those things need to be true in order for a borrower to be eligible for a loan modification. In this case, it fails in both regards. It doesn't reduce it by $100, and it doesn't reduce monthly payments by 10%. So they're not eligible for a loan modification, and we go on to step 6. So now we're really into FHA HAMP. And this first calculation is pretty confusing. I'm not going to really go into detail about why I think FHA does it this way, but it's important to note that this is where you're setting the target payment. Unlike Tier 1, the target payment's not always going to be 31% of the gross monthly income. So the example I created here is an example in which their target payment is actually 80% of their current PITA amount. And it's possible, as you can see here, that one of the targets is 25% of their gross monthly income, that you could end up with a borrower with a modification with a monthly payment that's that low with respect to their monthly income, which can be really nice, obviously. So once we've set their target payment, and this is just running calculations based on the information you've already entered, you'll now go on to calculating their maximum partial claim. So the total partial claim amount is 30% of the UPB at default, less any previous Hi all, I hope you can hear me now. It looks like I got dropped from the call, but I'm back. So I'm not sure exactly where I got cut off, but let me just go back to the maximum partial claim real quick. So again, you figure out what the maximum partial claim is by taking 30% of the UPB at default, subtracting out any previous partial claim that was awarded, and that's going to be the maximum partial claim that a borrower can get. And now, let me take a moment here to explain what a partial claim is. So a partial claim is basically an amount where FHA will give this money to the lender. It's paying out from the insurance proceeds. But then you execute, or the borrower executes, another mortgage to HUD for this amount that will be due basically at the end of their loan term, or if they sell the mortgage, they're not going to, or sell the home, sorry, if they're not going to be charged any interest on it, but it's basically going to sit out there like a non-interest-bearing balloon. And that's what a partial claim is. So one potential loss mitigation option here under FHA HAMP is a standalone partial claim. The way in which you get a standard partial claim, I think these are going to be pretty rare, is you have to meet these 3 tests. The current interest rate has to be at or below the market rate. The P to payment has to be at or below the target. And you have to be able to cover all of the arrears with your partial claim. So in this scenario, they're not going to be eligible for a standalone partial claim, and I suspect for most people, they're not going to be eligible. So now let's look at the standalone FHA HAMP modification. This is exactly the same modification as we saw at step 5. It's a loan modification. You're recapitalizing at a market rate over 30 years. But now the question is whether or not this will yield, this will get you to your target payment. So it's a different question. There's a different eligibility criterion here than we saw at step 5. So in this case, the answer is no. Their target payment is below the monthly payment under a standard modification. So now we get to the loss mitigation option that I think is going to be probably applicable for most, or to most people, and the most relevant for you all. And that's where you're combining a modification with a partial claim. So here, what you're seeing is you're looking at we have the first one as UPB today, because we're looking at what is the amount that the borrower would owe on the loan if we were able to get rid of, essentially, all of their arrears through a partial claim. The next thing we're looking at is what is the principal supported by the target payment over 30 years. So there we're saying, okay, we know what our target payment is. We know what their monthly payment is. What if they paid that amount at a market rate for the next 30 years? What principal balance would they pay off there? In this case, it would be $434,000 and change. So now we're saying, can we get to their target payment with a partial claim? So you'll see that the next calculation is the principal deferment needed, because here we have the principal supported by the target payment is less than their UPB today. So not only would we need to wipe out all of their arrears, but we'd actually need to defer a portion of the principal balance. We need to roll in some of that into the partial claim, right? So that's the way we could get them down to a principal balance that they can pay off with their target payment. Now you'll see in the next cell there, right down here, this is the size of the partial claim that they would need in order to get this modification. They would need a partial claim at $116,860, right? But you'll see above where we calculate their maximum partial claim, they only have $84,700 or so for a possible partial claim. Had they not previously been awarded one, this would have worked. But here they don't have enough available to qualify at this stage. So what you do now is you go and say, okay, well, we couldn't get them their target payment with just a modification of partial claim. But what if we allowed for a slightly higher monthly payment, and we go all the way up? We can go all the way up to 40% DTI. So we'll add a little bit back into the principal balance until we've maxed out that partial claim and see what we can give them. So here, for this borrower, we can get a principal balance at $466,523, and that principal balance there would be just $2,746, and the debt-to-income ratio on that would be just 26%, 26.63%. And because we're below the 40% cap, they would be eligible for this modification. So they'd be fine. They actually have quite a bit of wiggle room in this scenario. So you'll see at the bottom, borrower is eligible for FHA HAMP modification. And just in the other, as we have in the other worksheet, there's a final tab, a final sheet here that lists out the terms. So now we see the monthly amount, the P&I, principal that they have, size of their partial claim, and the remaining terms of the loan. So that is the FHA Waterfall Worksheet. There was one thing I was thinking about that's come up a few times when we've talked to people about these worksheets that I wanted to make you all aware of, and that is right now, all the cells where there's calculations and the cells in which there's already text, it's all locked. So I think that some people like to take, particularly attorneys, like to take notes or change some things. I would definitely follow Joe's initial advice and always save as a new copy, particularly if you're going to change anything in the worksheet, because you don't really want to mess anything up. But if you right-click on a tab, you can unprotect a sheet, and that can allow you to change things like, we can say what type of employment income this is. We could say, it's construction or something like that. And so you can enter in those sorts of notes to make this worksheet, to customize it for you so that when you say go into a settlement conference, you really have a very detailed list of information about your borrower. And then similarly, this only works on electronic versions. You can also enter in comments, if, say, this is just an estimate or you suspect that it might change at some point. Those are a couple things you may want to do. So that is everything on the FHA Waterfall Worksheet. I know we're at the end of the hour, so I'll pause now to see if there's any questions.
So I see that, excuse me, I see that some folks have been asking questions through the chat, which is perfect, and I see that, Joe, it looks like you've answered at least 2 of them. You wanted to, hopefully if folks have similar questions, you can read through that, and if you still have further questions, follow-up questions, you can ask Joe or Aaron later on. We do have 2 more other questions that I wanted to address. For an FHA, I'm sorry, I lied, one more. When you get a maybe in the response at the sort of the results page, just strategy-wise, how have you been using that in the courts to argue for or against a modification? Well, obviously for a modification.
Yeah. So what's going on when you get a maybe is that your borrower has a debt-to-income ratio outside of 25 to 42%, but inside of 10 to 55%. And what HAMP Tier 2's policy requires is basically for servicers to create a uniform policy in writing saying what their DTI range is going to be. So, for example, if you deal, let's say you're dealing with Chase and your borrower's debt-to-income ratio is 50%. What I would do as an advocate is demand a copy of their written policy saying what their DTI range is, because it has to be uniformly applied. They can't give out modifications to one person who has 50%, but decide against doing it for another person who has 50%. So the key is to ask for a written policy, and if they don't have a written policy, then it's assumed that they've accepted the 10 to 55.
At this point, I don't see any hands raised in my little panel board here, and I don't see any additional questions that have not been addressed in some way. Hopefully that answers everybody's questions. I think if we have any, again, if you have any follow-up questions, Joe and Aaron, I believe, have opened themselves up to receive those questions, correct?
Yeah, absolutely.
We have, and particularly if you run across any bugs or any complications with the worksheet, we are really committed to making these, as good as they can be. So we will really appreciate any feedback that you all may have.
Okay, great. Erin and Joe, thank you so very much. I know that I have certainly learned quite a bit of this, so I appreciate that, and I hope that others have gained something from it. If anybody has any follow-up questions to this, please, again, follow up. Feel free. These webinars will be held at this point the first and the third Wednesday, the first being the Hot Topics webinar, and the third Wednesday of every month from 12 to 1 will be the Basics courses. If you wanted to submit for CLE credit or for general attendance certification, please make sure you follow up with Michelle Peterson. Michelle, do you have anything else?
Just a reminder, I put the CLE verification code in the chat box. Hopefully everybody was watching and paying attention to that. But I'll also verbalize it for folks. It's MEM-07. So you'll need to write that code on your attorney affirmation form and send it back to me. And as my email had stated, I'll issue the credit within 30 days.
Okay, and we have, looks like really quickly, Carol Richmond has raised her hand. I don't know if she's on the phone or the computer or if it's a mistake. Nope, it looks like they went away. So never mind. Everybody have a great day.
All right, thank you all very much. Thank you.
Thanks, bye-bye.
Bye.
Bye-bye.